Joining us now to talk markets and more is Tom Lee, head of research at Fundstrat, chief investment officer of Fundstrat Capital. He's also the chairman of BitMine as well as a CNBC contributor. We've got some new stuff to factor into your either bearish or bullish case. I assume it's still somewhat bullish, but okay, the economy looks like it may actually be slowing a little bit. Last week, the markets definitely retrenched. You've been solidly bullish since, Liberation Day. But last week was a setback, and August is not always a great month. You think we get a little bit of choppiness here? Are you still bullish?
Well, last week was definitely consolidation because we had 5 days where the market opened higher and closed lower.
Really?
And they call that bearish engulfing. It makes sense because we're consolidating that 28% gain from the April lows. And on the job stuff, I think it's just the data's catching up to what we already know. The labor market's been soft, right? So it's, I think, a positive setup because now the Fed has more ammunition to make a dovish pivot in the fall. And it's not too late because we know the thing that they're going to stimulate is the housing market. And you had a couple guests earlier talking about that. And so that is what strengthens the economy in 2026. So I think it's quite a positive setup. We're just consolidating and then we make a bigger move higher.
Is it fair to say that since it's a dual mandate, that maybe the Fed should have been able to think that there was more risk to a slowdown than to inflation? Do you think they missed that a little bit and they're fighting? I don't know, but Trump said you got to cut, so they couldn't. Maybe they had to err that way just for political reasons.
Yeah, I think the Fed needs to demonstrate independence, but you're right. I think when they look at their dual mandate, they're probably drifting further from the employment metric now because the unemployment rate, if you use the existing participation rate before this report, it's almost 5% now. So the Fed now has to be considering the risk of jobs market actually going into a cycle of weakening.
Right. But
Welcome, everybody, to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks rebounded sharply on Monday, recovering from last week's sell-off sparked by disappointing labor market data and continuing trade uncertainty to cap off what was the best day in the S&P 500 since May, and red was far and few between. We had Adobe right here falling 2.57% because of the Figma IPO. Berkshire Hathaway reported its earnings. It was down 2.9%. We'll talk about it. A couple of the big energy names were down, but the rest of the energy space was fine. So maybe some company-specific news going on right there. And then Amazon was down 1.44%, leading the consumer discretionary space lower. But Tesla, Home Depot, DoorDash, McDonald's, Bookings Holding, this entire sector, very, very green. And so too was pretty much every other stock. I mean, everything in the tech space is very, very green. We saw Nvidia up 3%, ABGO, Microsoft, even Apple was up 0.5 percentage point today. Google and Meta, very, very green, up 3%, leading the consumer discretionary space lower. And today was just a broad-based rally coming off the selling we saw towards the end of last week. Every single sector was green today. The S&P 500 up 1.49%. And the only sector weighing on the market was energy, down 0.24%. But today was completely risk on, tech outperforming, communications outperforming, utilities up in the show. And we saw some of these more defensive sectors, stuff like staples, stuff like real estate, and even gold at the bottom end of the rally. Still green, but at the bottom end of the chart, telling us that we really just saw a risk on rotation. And it happened across the board today. Small caps, mid caps, large caps, all in the green, but really growth as a whole really outperforming. And again, those sensitive and those cyclical sectors outperforming. Large caps putting on a show, small caps putting on a show, but just green through and through. And this was the case everywhere. Europe was very green. South America was very green. Asia was very green. India, China, except Southeast Asia right here and a part of Japan. But South Africa, the Middle East, Australia, most geographies, in fact, about 90% of all geographies worldwide were green today. So just seeing a real bounce back after some of the volatility we got last week. And I think what the market is starting to do is price in rate cuts. And even the Fed are starting to talk about this. Fed Daly came out and said the time for rate cuts is nearing. We may even need more than two. The market has actually started to price in at least 25 basis point cut of 74% in September. So right now, the market is saying we will get a cut in September after the horrid labor market data we got on Friday. And Trump in full force saying last week's job report was rigged, just like the numbers prior to the presidential election were rigged. That's why in both cases, there were massive record-setting revisions in favor of the radical left Democrats. Those big adjustments were made to cover up and level out the fake political numbers that were concocted in order to make a great Republican success look less stellar. I will pick an exceptional replacement. Thank you for your attention to this matter. And Donald Trump saying his replacement should be announced by the end of this week. So all in all, that's what the market is sort of reacting to, along with somewhat of, I guess you could call it a dead cat bounce or just a bounce of last week's sell-off. So rate cut expectations, the market pricing that in, and as a result, momentum built from that, and stocks were up very green today. We did get some very exceptional data today, but nothing that really moved the market. When you look at total vehicle sales, that was 16.4 million versus 15.9, and then factory orders came in slightly better than expected, negative 4.8 versus negative 6%. However, still negative on the month. However, our factory orders ex transportation looking a lot better. We also had a couple of bond auctions, the 3-bill and the 6-month bond auction. Some other market movers today was Tesla up 2.2% after the board approved a $30 billion restricted stock award for Elon Musk. So he's going to get paid, guys. This has been going on for like 2 years now. The shares vest in 2 years. They're locked for 5, and Musk is to pay $23.34 per share from his package, which is equivalent to the same strike as his 2018 comp plan. The stock is now $309, so it's essentially more than a 10x. It's like a 15x off back. So you would pay that any day of the week. American Eagle Outfitters, guys, on the back of the newer Sydney Sweeney campaign, was up 23%. American Eagle sold out its collection, every single piece of clothing. The stock is up 23% on the back of that news. America is back. And then looking at some market movers with regards to earnings, Berkshire Hathaway reported their earnings on Sunday. And you can see here they beat on revenue and beat on earnings, but operating income fell 4%, revenue fell 1% over the year. The market obviously didn't like that momentum we saw, down 2.9%, nearly negative for the year is Berkshire Hathaway. So very incredible to see the momentum lost after some very strong momentum we saw at the start of the year. Another market mover was Palantir. They reported earnings after the bell. They were up 4% today, up 3.8% after those earnings. And, you know, they beat on EPS, beat on revenue. They actually raised their full year guidance to $3.9 billion, free cash flow of $1.8 billion. So the stock still trades at, you could see, a price to sales of 100, a PE ratio of 300. But essentially what Palantir told us today is that AI is still booming, and they are a huge beneficiary of that. It does look like this rally in Palantir will continue. Hims & Hers Health put up an ugly quarter, missed on revenue expectations, missed on EPS. The stock was down like 11% here in the after hours. After it reported its earnings, revenue still grew 73% year over year. So it's not like a total disaster. The business is doing better than ever if you look at it. If you look at fundamentals, excluding the price. Q3 guidance was a little bit soft, coming in at 580 million versus the 586 million expected, but the company went ahead and reaffirmed its full year outlook. And this was the first quarter where I looked at Hims and went, yeah, these numbers are not super fantastic. They're just subpar. And that is why the stock was down 11% or 8%, depending on where you look at. All in all, the business is doing great. The stock was probably just a little bit rich coming into this print, and now we're just seeing a little bit of a normalization. That being said, still bullish on the name. I like the business, and this company is still growing at a very, very fast clip. And then for everything we saw today, it was 4,700 advances, 1,500 decliners. We saw net inflows to both the NASDAQ and the New York Stock Exchange, with the S&P 500 up 1.47%. And we regained market momentum. We regained the 50-day right here. We regained the 150-day right here. And we saw improvement in the 200-day, the 100-day. We just saw improvement across the board. Very, very solid. We'll see if this momentum gets sold into or if we will continue higher. But let's hop on the charts and talk about it. Now, guys, looking at the charts, you can see a very solid day through and through. Large caps gained, the equal weight gained, small caps outperformed, the Russell 2000 up 2.1%. Very solid stuff. Mid caps, small caps also in the fold. Growth outperformed value, but both up in excess of 1%. Growth up nearly 1.9%. And we can see it even in the after hours of futures holding these gains we're seeing down ever so slightly in the NASDAQ 100 and the Dow Jones, but the S&P 500 flat, the RTY also flat. International stocks were also really, really good. The stocks 600 up 0.9%. The Israeli ETF up 1%. China ETF, China stocks up 2.2%. Then looking at cryptocurrency right here, Ethereum up 6%, really continuing its outperformance against Bitcoin, but Bitcoin also up 0.69%. Volatility ticked down both in the front month VIX and the spot VIX. And you can see here that the market is beginning to price in rate cut expectations. You can see here the 2-year yield fell, the 10-year yield fell, as well as the 30-year yield after that jobs report. And I do think we're going to see yields continue to move lower. And then looking at the dollar, it was largely flat. TLT gained ever so slightly. Gold was up 0.3%, silver up 1%, and really just a day for equities, for risk assets, for outperformance. Now let's talk about the S&P 500. And you can see here on the weekly chart, we have a very, very clear uptrend making all-time highs right here. Then we had the tariff tantrum. We put in a low. You could call it an equal low if you want it, but we put in a low. We've paired all of those losses and then some, reaching last week a new all-time high, as you can see right there. However, towards the end of the week, we saw a lot of volatility. We put in a bearish engulfing candle. This is on the weekly chart at the top end of the core resistance zone. And this week, while the week has just started, we did bounce back ever so slightly. If we zoom in into the daily chart, you can see this is the S&P 500. And then we actually just zoom in right here. You can see that we put in a low right here, a big wick on Friday. So buyers came in at the gamma flip near the 6,200 area. And who would have anticipated the strength we just saw? We had a gap up and go. That is one of the most bullish candles you can see. Very minimal wick at the top there, virtually no wick at all. And you could say we somewhat closed the gap, I guess, if you compare it to that wick right there. And ultimately, right, if the bears want to see continuation for sell-off after this massive gap down and this massive candle right here, this daily bearish engulfing candle, they probably need to start selling right here at Thursday's lows, call it the 63.40 area. If the bulls go ahead and retake this level tomorrow, right, I think we probably will go ahead and touch that 6,400 area. However, this is probably where you're going to see the bears find strong resistance right here. So this is the line in the sand, the 63.40 area. Above it, we probably go to all-time highs. If we find heavy resistance right here, the S&P 500 will move lower. And again, and let's go ahead and quickly look at a fib retracement from the highs right here to the close of last Friday. If we go ahead, measure that, you can see that we're at the 50% mark right there. So this is the do or die place that we're in right now. Above, we're bullish and we're going higher. Below, we're bearish. So what I would do is probably just, wait the next couple of days, action occurs, and if we go higher, that would probably be your opportunity to add. If we do go lower, you could probably wait out and sit through the price action. Either way, in this type of price action right here, I would say it's probably prudent just to give the market some time to breathe, shake off some of the volatility we've seen on Thursday, Friday, and today. Let the market moves play out, and then you can take the momentum on the other side of that. Looking at the NASDAQ 100, up 1.87% today. Very similar situation. This is a line in the sand. It's like the 50% mark. Above it, we're going higher. Below it, we're going lower, targeting the gamma flip zone as potentially the put support zone. But on the upper end, right, the reward doesn't seem that great because you ultimately want to target the core wall right here. So we'll see what happens, but let the market do its thing. Looking at the RSP, up 1.22% today. Very similar situation. It actually did go ahead, close that gap, and form a candle above it. That's very, very interesting. We'll see if this goes higher. I do think that this index is relatively cheap. Still trades at about 15 times earnings. So still relatively cheap. And guys, we know that earnings has been very, very good so far this earnings season. And ultimately, even if we do go lower in the S&P 500, this is a dip buying opportunity. And I explain why in this post right here. I'm going to go ahead and read it to you guys. I said, If the S&P 500 goes ahead and retests the 59 to 6,000 area, if it does that, you want to load up, right? The recent pullback in US stocks isn't a reason to panic. It's an opportunity. The earnings outlook for the coming year remains robust, and the strength is what matters most. Yes, the S&P 500 has stumbled after a record-breaking streak of all-time highs, a weakening labor market, slowing jobs growth, and rising unemployment. And by stumbling, I'm talking about the move from the all-time highs we saw into the lows on Friday. And even a fresh tariff headlines have spooked the markets. But zoom out, earnings revision breadth shows that the rolling recovery has begun. This is what I'm talking about right here. While the Fed stays on hold for now, in cooling inflation plus a soft labor market equals rate cuts, aggressive rate cuts. Translation, liquidity is coming, earnings are strong, stocks are still the best game in town, and pullbacks like this, therefore buying. And you can see right here, Q2 earnings, right, is 11.2% versus the 5.7% estimated at the start of earnings season. So guys, any dip we do get, if we continue to move lower, buy those dips. And if the market continues to rally, I wouldn't be surprised because earnings are extremely strong across the board. And it's broad earnings, right? Tech's doing well, com services doing well, discretionary doing well, financials, really great earnings. We're also seeing great earnings in Europe. Even in China, stocks are doing really, really well. And so ultimately, guys, any dip we do get is an opportunity to buy, but do understand that this month of August and September, we do see quite a bit of volatility. And that's why I'm saying, look at this line in the sand right here, the 63.40 area. And if we find resistance and the market continues to move lower tomorrow, right, get some cash available, get ready to buy the dip. But if we continue to move higher, we can continue to grind up, all the way to 6,600 and then find a correction right there. So it just depends. You need to watch the market momentum and tune into my videos every single day to show you where we're going. Now let's have a look at Bitcoin, right? We haven't looked at Bitcoin for some time. And you can see right here, and with Bitcoin, you could see we bounced off this critical area right here. Let's go ahead and actually put a line right there. And you can see we used this zone as support for Bitcoin right now, right over the weekend here on the weekend trade. We used it as support right here. We've bounced up. And at this time, we used it as resistance right here, partially right here, and broke up to all-time highs at this level. This is a strong confluence zone right here. And ultimately, this is the line in the sand. Above it, we probably will go ahead and fix those all-time highs. Below it, right, we can find price discovery very close at the 100,000 area. And then there's very solid support here at the 98,000 level. So yeah, this 111K zone, this is the line that we really want to look at. And ultimately, the path of least resistance for Bitcoin is for us to move higher, because when we compare Bitcoin, which is this blue line right here, to global M2 money supply, which is this yellow line, we offset it between 80 to 100 days. We get the path of what Bitcoin does. When Bitcoin consolidates, M2 money supply consolidated beforehand. When M2 money supply rallies, Bitcoin follows suit. And we can see here that M2 money supply is telling us that we probably will go higher into the end of the year, into July, September, and find a bit of volatility right here. Now, we are diverging, don't get me wrong, but we diverge about 20% of the time. And we can definitely see some weakness here in this August-September period and then go into the end of the year for a rally. Either way, the path of least resistance is higher. And this is ultimately where we want to go ahead and buy dips in Bitcoin. Anytime we get to that 110,000, possibly even the 100,000 mark, we want to buy dips because we're going to see 130, 140K Bitcoin by the end of the cycle. And that could end by the end of this year. Ethereum, I'm actually significantly more bullish on. Now, we are seeing resistance right here at this key resistance zone. If we go on the weekly chart, you could see that this is a very strong zone right here. We use it as resistance multiple times, and the price action is not setting up really well. You can see we rallied all the way to the top right here. We then broke below these lows, forming a low right here. However, we have seen a massive rally since. And what the bulls need to do right here is move up, break above this 4,000 area, find support, and then continue to move higher from there. If they don't, there is big risks that we trade back to this zone right here, or potentially this heavy zone. So resistance at this top level right here, it's not what you want to see as a bull, but it does look like we are bouncing back. We'll see if bulls can continue and follow through. Looking at some of our other parameters, guys, let's look at the 10-year yield. We continue to see this massive downtrend. We're at a critical zone right here. If we go ahead, break below this level right here, that does open up potentially a 10-year yield below the 3% mark. That is partially why we're seeing high beta outperform large caps. Look at the RTY up 2.1% versus the S&P 500 1.4%. So critical zone right here for yields to move lower, and that means bonds are actually going to move higher as a result. So bonds are going to get bid up. Now the dollar, guys, we said we're looking for a 100 DXY. We did actually get that. I think ultimately if we can put in a higher low below this 97% area, I do think we do go higher, and I do think we're going to see continued strength in the dollar into the end of the year, but not without some volatility. And then looking at gold really quickly, you know the play with gold is sort of trading in this range, looking for the next move to the upside or the downside, depending on what the market wants. I do favor a move to the upside, guys. Now, guys, diving into sentiment, this is the fear and greed index, and we've seen a sharp drop in this index from the extreme greed area into the neutral area right here in just 1 week. And this signals a massive and rapid shift in market sentiment from euphoria to slightly cautious. This obviously reflects growing uncertainty about the macro tariffs, a little bit of profit taking here at the highs, and also just general negative reaction to news, specifically economic data and geopolitical risks. Now, obviously, this doesn't guarantee that we are going to sell off, but we are in a very seasonally weak period of the year. This is the monthly average for the S&P 500 over the last 20 years. And if we zoom in into August and September, you can see the return year for August tends to be 0. The return for September actually tends to be negative. So we may have a bumpy August and an even bumpier September. However, at the end of the day, guys, you want to go ahead and buy the dip because we have a positive month in October, the most positive month here in November, and a positive month in December. So we're looking for an end of year rally. And right now we're looking for opportunities to buy the dip here in August and September. So what can a massive dip look like? Well, if we just look here at the minimum return, you're looking at anywhere, I would say, negative 6% in the S&P 500 to about the negative 9% range. Somewhere in between here, this is probably good for us to go ahead and buy the dip. So I would say, let's round it up, 5 to 10% dip. That's what we're looking for in the market. And we are looking for opportunities to buy the dip because the macro is looking really good. Second quarter earnings is 11.2%. That's year-over-year growth for the quarter versus the expectation of 5.2%. Absolutely insane. The beat rate is 80.6% against the historical average of 67%. If you exclude energy, you're looking at low teens growth, 13.2% and 6.8% with regards to revenue. Leading the charge is comm services, tech, and financials. And this kind of outperformance isn't just a beat, it's a bullish mic drop. And any pullbacks we get is a gift for the patient bulls looking to take advantage. Now, guys, looking at the macro, things are also aligning up really good. The Fed's GDP now did tick down from 2.3 to 2.1%, still above 2%, and Q3 growth looking rather robust at the moment. And even with this really bad jobs report we got on Friday, when you look at the United States Economic Surprise Index, we're still in positive territory, so nothing crazy has happened. And the economic data, has been a little bit wonky here in the last couple of months, but for the most part, it's been very good. And to be honest, I expect much of the same because the consumer is still spending. MasterCard's card growth data came out last week along with Visa, and we're looking at 9% year-over-year growth. This is total volume growth. This is such a pure barometer for how the consumer is doing, not just in the United States, but worldwide as well. It's a worldwide 13% growth. United States looking at 8% growth for total 11% volume growth. Essentially, consumers are spending more than they were last year. June was kind of weak, looking at 4% United States growth, but that's because July rebounded and we absolutely crushed it. And like I said, this data right here is pure. It's purely indicative of the consumer. And many will argue it's just people taking out credit. But when we actually look at the data, and this is from Visa, if we look at debit payment volumes right against credit, we can see that debit volumes are outpacing credit volumes. 10% here for the third quarter versus 7% on the nominal figures, 7% and 9% adjusted for constant currency. So, debit growth is outpacing credit growth. And so this isn't just a people taking on debt story. This is just a healthy consumer story. And that's why ultimately this dip we do get in the markets, if we continue to move towards that 6,000 level, we need to go ahead and buy that dip. Now, guys, looking at data for the rest of the week, there isn't really much of anything. We got the ISM services tomorrow. That's about it. We're looking for a number in the 50 region. Right there, 51.5. That's the previous number, sorry. And then later on in the week, we get like initial jobless claims. And we have quite a number of Fed speakers, Cook, Bostik, Mazalim. That's pretty much it. Earnings is what's going to move the market. So today we had Palantir and Hints, some big names reporting, absolute firework with those names. Then tomorrow before the open, the one I'm going to be watching is Lemonade and DigitalOcean. These are two companies on my watch list. I'm actually looking to get into positions. However, we also have Pfizer, Caterpillar, BP. Leave in the comments which one of these stocks you want me to cover, guys. And then after the close, we have AMD, SMCI, Arista Networks. So we probably are going to cover AMD, potentially Arista Networks if I have time during the day, but we'll be covering Lemonade and AMD tomorrow, definitely before the open and after the close. And then we'll cover the rest of the week later, guys. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, leave a comment for the algorithm. Cheers.